Welcome, everybody. We'll get started in just a few minutes, or just a few seconds, I should say. So hold on. Thanks for joining us today. Well, welcome, and thank you for joining the Tippie College of Business's Life Lessons webinar. My name is Barbara Thomas, and I am with the Tippie College of Business. Now, today our webinar is titled Ready, Set, Retire, Planning for Your Golden Years. Now, this webinar is one of 7 Life Lessons webinars that are designed to provide you with insight and ideas for each stage of your life. And I will include a link to the full list of those webinars in the chat today. Now, all of our webinars are free and they're open to the public. We just ask that you register. So feel free to share this information with anyone else that you feel would want to attend. Our webinars are recorded and they are shared on the Tippie College's YouTube page as well as on our alumni web pages. Several days after our webinar, we will send an email to all those who registered for this webinar with a link to the video and the transcriptions. In that email, you will also see a link to all of the handouts that our speakers have provided. Now, before we begin, I do want to reiterate to everyone that these webinars are designed to provide ideas, but are not providing you with official financial or legal advice. After attending our webinars, we encourage you to discuss issues with your financial planner or your lawyer. And today, during our webinar, you can submit questions to our speakers through the Q&A button that you'll find at the bottom of your screen. We'll do our best to answer as many questions as we can. And now to introduce our speakers, our presentation today will be moderated by Cathy Zaharis. Cathy is a professor of practice at the Tippie College of Business, where she has been working with finance students at the undergraduate and the MBA level since 2008. She has taught wealth management to undergraduates at Tippie and in our London program. Prior to her time at Tippie, she spent 23 years as a portfolio manager and analyst at Principal Global Investors. Cathy is a chartered financial analyst and is past president of the Iowa CFA Society. She currently sits on the investment committee of the University of Iowa Center for Advancement and the retirement investment committee of the University of Iowa. In addition to her current role at Iowa, Cathy is an independent trustee of North Square Mutual Funds. And now, more about our panelists. Jim Wessels is a financial advisor and partner at Vision Financial Group. He holds the highly regarded industry designations of Chartered Financial Analyst and Personal Financial Specialist credential, as well as Certified Public Accountant designation. Jim's financial career spans 3 decades, over which he has built a deep, diverse background in pension, tax planning, trust, estate planning strategies, financial planning, and investments. Jim earned both a bachelor's in accounting and an MBA with an emphasis in finance from the University of Iowa. In addition to leading a successful planning practice, Jim aids other financial advisors across the country in their practices. He is very involved in the community and was recently recognized for his philanthropic achievements and profound contribution over the past 20 years to a nonprofit organization. Kudos, Jim. Justin Ryan is a financial advisor and founder of Hawkeye Financial Group. He holds the highly regarded industry designation of Certified Financial Planner, as well as the Accredited Investment Fiduciary and the Chartered Retirement Plans Specialist designations. Justin has been advising clients in the areas of asset accumulation, wealth management, estate planning strategies, and retirement income planning for more than a decade. He is passionate about helping people evaluate, plan, and accomplish their financial goals through the use of what he believes are the best investment techniques and vehicles available. Justin received his bachelor's degree in economics from the University of Iowa. We want to thank all of our panelists for joining us today, and a special thank you out to Clark Buss, who has been instrumental in our planning efforts for this event. And with that, I will turn it over to Cathy Zaharis. Cathy?
Thank you very much, Barb. You might be aware we've had this series of webinars, and on the last webinar, they talked about different documents you might need for retirement. So that was an excellent program to understand some of the legal aspects of your retirement planning and your financial planning. This webinar will focus on planning for retirement. And oddly enough, this is my last semester of teaching. So this is front and center, very interesting for me. We've all worked hard to save our money, and now we need to think about retirement. We spend so much of our careers thinking about accumulation. The thought of deaccumulation and what we do in the next stage is so important. So we're going to cover different ways you can prepare for retirement and how to determine if you are ready and what is next. So I'm going to go through a couple of polling questions here shortly, but I want you to see just how much people have had in savings, right? So the good news in planning for retirement is that 2/3 of us have either an IRA, have an employer-sponsored plan, or we have both. But there are 1/3 that don't have any savings specifically geared towards retirement. Where things have happened is also shifted here in the last several years. As you can see, in 2020, 2/3 of the assets are in what we call defined contribution plans, or something that we save, our IRAs, our 401ks, our 403bs. So the money is in components that we've saved, which is different from maybe past generations where you had more and more assets that were on the pension side. So it's more up to us to think about how to retire and how to plan for retirement. So Barb, could I have you put up our first question in our poll? And that is, where are you currently at when it comes to retirement? So this will give us a better sense for who's on the call today so that we can maybe think about our answers in our program. Give you a couple.
Like a lot of them have answered. So I'm going to go ahead and share the results.
Awesome. Thank you. Excellent. So we have a lot of people who are being proactive in that you're more than 5 years away, and about a little over 1/3 are planning to retire. You're right in my wheelhouse. We're all planning to retire within 5 years. Excellent. We have a second question, which is, what are your biggest concerns in retirement? And this also is really important when we think about how to plan and what to focus on, the different issues that may be important. And I've seen some of the questions that you have sent before our webinar, and these are very much in line with some of the concerns and questions that we have already received.
Okay, we're quickly approaching 85, 86%. I'll give you just a few more seconds to finish that up.
We should have added all of the above, right? I'm guessing that a few of you might have wanted that one as well. Excellent. Thank you very much for sharing your thoughts on this. And certainly outliving the money is a critical one. As well as healthcare, which I know several questions came, and we'll talk about all of these conversations here shortly. For some people, planning for retirement can seem like a daunting task, whether it's a long way off or, as several of you have noticed, you're right on there. You're coming up to it in just 5 years. Justin, how have you helped people of all ages most effectively prepare for retirement? What is that process?
Thank you, Cathy, and early congratulations on your retirement.
Thank you.
So a financial plan, I guess, in my words, is really putting all of the pieces of the puzzle together. I think as we all age, most people start to figure that out, that accumulation is really the easiest part of the equation, right? We go to work, we have our TIA accounts, our 403bs, our IRAs, and it's just taken out of our paycheck. It's super easy. The really difficult part is distribution and doing that effectively. And like the poll states, not doing too much too early so that you don't run out of money. And what the financial plan does, and where we spend most of our time, is putting all of the pieces of the puzzle together. How does your TIA account work? How does your other IRA accounts work? How does Social Security working with that? If you're married or not married, how you take Social Security is probably going to be completely opposite, depending on how you answer that question. What does your family longevity look like? If you're like my family and everybody kicks off at 80, but if you're like my wife's family and everybody lives to 105, those are two completely different looking plans. So a plan brings everything together, all of the moving parts, so they can work effectively with each other: taxes, inflation, your goals, etc. And that's where we spend the bulk of our time.
Cathy, I think you're
Sorry about that. So who can benefit from one of these financial plans? So what is it specifically? What are the pieces of it that matter?
Yeah, absolutely. This is going to be a little generic, but I think everybody should have a financial plan. Even if you're in accumulation phase and you're 30, you want to make sure you're saving enough money to get to some broad-based goals. It looked like most of the people on this call are within 5 years. You don't want to get to the doorstep of being one semester out and having a problem and go, oops, you have no time. So I think everybody needs a financial plan. I think the earlier you start your planning process, the better. You have more times to fix the problems that you may or may not have. I'm not trying to scare anybody, but almost nobody's plan that walks into our offices is just hunky-dory and perfect, because we all have this grand imagination that we've saved enough. But unfortunately, we usually do not keep our goals in line with reality. And so sometimes the financial plan is a reality check. But honestly, everybody should have a financial plan. And most people spend more time planning their next vacation than they ever do on their retirement, on their next 30, 40 years of their life. So spend some time with a qualified professional and organize this part of your life. Everybody can benefit.
Excellent. Thank you, Justin. And when you're doing this planning, or maybe even before you're doing this planning, sometimes people really have this goal of retiring early. And so that's sometimes quite important. So Jim, how do you help them determine if they can retire early or not? What is the process for that?
Well, you do have a financial plan that you start with, but like all financial plans, a good plan changes. And really post-COVID, and as businesses started reopening, we started seeing much more interest in retiring early. We've helped all sorts of people crunch numbers to make this determination. My wife's grandfather did a lot of carpentry work and frequently referenced, measuring twice and cutting once. And retiring early means likely leaving employment at your peak earning potential. You're never going to make more in your life. You want to make sure you've considered all the variables before giving up on, all you've done in your career to get where you are. But as the slide references, a financial plan can help you determine the impact of retiring early. And you'll notice that theme here, circling back to the financial plan as Justin had referenced. You started early in life and you put it together, and it's really more of a living document that changes as you work through your career. But I tell everyone that they could retire tomorrow, but then ask them if that's the retirement they really want to have. And most people work longer, recognizing they want to do a little bit more in retirement than, just sustaining. And you're supposed to have fun in retirement. I hope Cathy has a lot of fun in retirement. But while most guidelines use 80% of pre-retirement income to make ends meet, it really depends on your priorities. But for most people, retiring early means, retiring before age 65. And for some, retiring from a primary job may be possible by phasing down instead of, a full retirement, actually working past age 65, which sounds a little bit counterintuitive that to retire before 65, you actually work past age 65. But we see a lot more of, I'd call it like that part-time employment or something to stay busy, or the additional spending money, or to work to maintain healthcare. But there might be a number of reasons why it ends up happening that way. But regardless, as you retire before age 65, it does present a few additional risk factors to continue to consider. And, those are, kind of highlighted on the next set of slides. So this really goes through what we try to highlight as the 5 key retirement risks. And that's the longevity risk, inflation risk, sequence of returns risk, market risk, and healthcare risk. But breaking these down, we'll start with longevity risk. If we knew how long you would live, we could better define the time period you needed the cash flows, but we don't. Although we have some actuarial tables to help guide us a little bit through that. But when retiring early, it increases the number of years you're going to, need cash flows, and decreases the number of years you're saving, or at least not drawing from the nest egg. But because we don't know exactly how long we'll live, we tend to save a little extra to account for this. And despite, many people desiring for the financial plan to end as they spend their last dollar, most people leave something behind, and, having not spent it all. And that's the importance of estate planning, which I think you covered a little bit more in detail in the last presentation in the series. The next biggest risk is more the inflation risk. Longer term historic averages have been 2.5% to 3.5%. And then in the past 20 years, we've seen that in the 0 to 2% range. But as we've illustrated 2.5% to 3.5% in our financial plans, many clients have questioned whether this was too conservative to illustrate. As a higher interest rate will stress the financial plan by creating a need for additional funds. But we're now seeing a shift in those inflation expectations. 2.5% to 3.5% may be too low for the next 3 to 5 years. And even in low inflationary periods, inflation slowly erodes that purchasing power that you have. So as you retire, the income you need now will not cover what you need later. This is especially important for people on a set income. A pension without inflation adjustments, as most don't have, may look good now, but if there aren't other funds to help you cover those higher costs later in life, your retirement may not be as much fun in the later years. This is especially important for people retiring earlier, as they will have more years where inflation can compound. So inflation is definitely important to factor into the whole equation. But the next 2 risks are really interrelated. Sequence of returns risk is the risk of below average market returns taking place earlier in retirement, and market risk is the risk of losses in a market downturn. The sequence of returns risk is important in that most financial plans plot out these detailed cash flows, and they're on an average basis, which gives the impression of precision, but real life doesn't happen that way. And the more sophisticated software packages, can produce Monte Carlo simulations across different scenarios. They try to estimate the market ebbs and flows that naturally happen. And, while it can produce the same long-term average return, lower returns in the early years can negatively affect the probability to succeed of a lot of those financial plans. But I do think we all understand market risk, that the market goes up and the market goes down. As a retiree, you still need to buy low and sell high, but you're now taking money out of the pot instead of adding to it. So liquidity reserves and a closer monitoring of cash flows help to manage around that risk. And then finally, healthcare risk is the one that many people overlook. We can't always control this risk. It's kind of like the offensive line in football. When it's working well, we don't really think about it or discuss it. But when it's not working, it's front and center, and it's about all that we think about. So I know we're going to talk a little bit more deeply about that in a few minutes, but about how to manage that type of risk.
Yep. Excellent. Thank you. And I know we're going to shift gears in thinking about the point where we are retired. And we've got all these risks in mind that Jim just outlined. But Justin, can you please talk about how the different drawdown strategies and the life cycle of spending during retirement? I think that's really important. As I look at my travel budget, I'm guessing next year is going to skyrocket. And it may not be as high when I expect to live to be 90. I'm expecting I'm not going to be traveling around the world. So I'm guessing that my retirement budget's going to change throughout my time. So can you go ahead and start talking about how we look at our budget when we retire?
Yeah, absolutely. Thank you. Yeah, Jim hit the nail on the head. Like inflation is one of those things that while we're working, we really don't think much about because hopefully we get a cost of living raise, our career advances, and we really just don't feel it like emotionally. But I always think back to my grandma, like when I was at McDonald's, it was a cheeseburger was 5 cents, right? And now the dollar menu is $2. That really gets highlighted once we get into spending our money, and as Jim alluded to, our fixed budget. On the slide here is our 4% rule. That's been around for a long time, and I think it's a good place to start. But I also think that's where it ends. It's a starting point because, as Cathy alluded, you're going to do some things earlier on in your career, or excuse me, earlier on in your retirement that you're not going to be doing later on, such as traveling the world. At 65 and 70, you're probably traveling while your health is good and you have exuberance for doing all these things. As you approach 80, 85, 90, you either get sick out of living out of a suitcase, you've been there, done that, or some things are starting to slow down and the kids and grandkids start coming to you. So spending in retirement is really important to map out with what goals are going to continue, such as food and housing, taxes, healthcare, and what goals would slow down, such as travel, vehicles, etc. So you will spend more in the early part of retirement than you will in your later part of retirement. And it's really important to not only realize that, but to have the plan match those goals, because then if the plan doesn't match those goals, you could be spending too much or too little because you didn't map out, to Jim's point, those averages. Average exists only on a spreadsheet, not in real life. So it really, really important. One of the things, the problem I have with the 4% rule is it's stagnant, it's flat. In some of our plans, we try to break out our goals specifically for that reason in inflation. Your cost of living day to day, traveling around, tooling around Iowa City versus travel, or specifically healthcare. Like your healthcare is going up faster than your gallon of milk. We all know that, but how many plans lump, hey, Mr. Jones, you need $50,000 a year. We'll tack on 3% inflation and go forever. Well, that's not lifelike at all. Unfortunately, it's not a reasonable place to start. But again, that's where it ends. It's the starting point. So on a drawdown strategy, we really want to make sure that we're taking control as many things as you want to control, or as we can control. Jim mentioned buy low, sell high. If we look at your accounts right now, that's pretty darn hard. You want to make sure you have cash flows, ample investments that have not gone down. We never want to force anybody into a situation where they have to sell something at a loss. That'd be a very bad strategy. And you can get into a toilet bowl situation, whether it's 4%, 5%, or 6%. You got to have this plan out for your distribution so that you don't force yourself into a corner to buy high and sell low.
Yeah, excellent. And I'm going to ask a follow-up question because we're thinking about retiring well, I think you answered some of that. What happens if you're retiring in a down market like today, right? So you're going to have different buckets. You're going to have to be thinking about different, or cash reserves. You're really going to have to be planning for that. Maybe you start doing some of that as you get closer to retirement. Is that how you should look at that? You really, so that you're not here at retirement like I am right now, and then being in a down market, not having any cash sitting around or anything flat, right?
Yeah, sure. I told two people in November that I think they should maybe delay retirement. And sometimes part of Jim's job and my job is not only the most fun, but it is to be honest with our clients, to give them not only what they want, but what they need. And sometimes what they need to hear is not what they like to hear. And so, depending on everybody's personal situation, they may delay retirement. In order to get that extra cash flow that they may not have, they may pick up a part-time job that might be in a hobby that they really enjoy. not to be sexist here, but I have a lot of gals that work at garden centers, and I have a lot of gentlemen that mow greens, maybe at Finkbine, because now their hobby of golf becomes free. There's all sorts of really fun ways that don't feel like work to bring in a little bit extra cash to add that flexibility.
I know exactly somebody who is working at a golf course and gets to play for free. That's a key advantage on that one for sure.
Yeah.
Jim, I'm gonna
Yep.
shoot it over to you to talk about Social Security. And we got a lot of questions beforehand about Social Security, so it's clearly top of mind for a lot of people. And how does that play into our plan for income retirement? And I know there's a lot of options to consider when thinking about taking it on, and you talked about withdrawal strategies. Can you go into that in a little bit more detail for us?
Sure. Social Security is something that we model out in financial plans, although there's a lot of discussion now about potential changes to the system. And as you noted, there were several questions that we saw like leading into the presentation. So we knew this was going to be an area that we should probably put a little bit more depth into. Most of those questions related to kind of the nuts and bolts of how it works, as well as the potential for change that's coming here in the next few years. But first, the nuts and bolts. For individuals, previous adjustments to Social Security gradually shifted the full retirement age over a number of years from age 65 to age 67. So everyone born in 1960 or after, they have a full retirement age of 67. For those born prior to 1960, the age is still gradually going up from age 66 up to age 67, and they're somewhere in between. Every year it's like a couple months. But from full retirement age, you have the ability to take Social Security as early as age 62 or to delay as late as age 70. And for someone with full retirement age at age 67, taking Social Security at age 62 could potentially reduce their monthly benefits by as much as 30%. It's important to note that this reduction is for the rest of their life. In contrast, by delaying Social Security, it grows by 8% a year after full retirement age, which could potentially be a 24% increase in benefits, again, for the rest of their life. These are illustrated on the slide that you have in the presentation. But for most people, as they look at those numbers, the break-even period is, somewhere between age 78 and 80, depending on what you have for investment returns and inflation assumptions. But for most people in their 60s, there's at least a 50% actuarial probability of living past those break-even ages. Though, like Justin had talked about earlier, family history and the health of each person, is going to weigh in how the decisions are actually made. But most clients have more risk of outliving their money than they have a greater need for income earlier in retirement. And that's where, for a lot of people, you're better off in delaying. But beyond that break-even period, which is, I'd say that's one of the most frequently asked questions that we get for Social Security. There's all sorts of other nuances to Social Security. First, when one spouse passes away, the lower of the two spouses, Social Security goes away, with the survivor receiving the higher amount. There are also other special survivors options for children and widows to consider. There's some positions entirely exempt from collecting Social Security taxes. And I know Justin was talking about like TIA, CREF type pensions and such, but there are some positions that people hold that exempt them from Social Security, although it's usually replaced by some other form of pension and such. This used to be an even greater topic, and we still get questions about it, but there were options to consider, such as like file and suspend or restricted application rules and things like that. But it was a few years ago that they actually simplified Social Security with some legislation to remove some of those loopholes in the system. But it's all, I find it's all still complex enough to require modeling to better understand how it all interacts.
And I would encourage everyone on here to go onto that Social Security website. They can map it out for you. What if you retired, I'm 62, it will show me what I can have now. It will show me what the estimate might be at 65, at 67, and at 70. Can you also touch on, because as I mentioned, I'm going to be continuing to work on my mutual fund activity. So having income can hurt my Social Security. Like that might even be a reason why not to take Social Security early, right?
Absolutely. Taking income prior to full retirement age, it reduces your Social Security if you're above the annual limits. Those limits, as of last year, they were just a shade under $20,000. So there's not a whole lot of earned income that you can have while you're taking Social Security.
Now, is a pension or withdrawal from my IRA, that's not considered earned income, is it?
It's not. No, it's not.
Okay. Thank you.
Mm-hmm.
I'd like to add one thing here is this tends to be a very emotional versus rational decision-making process. A lot of people feel like, well, I paid in my entire time and boy, I'm taking that Social Security because I don't want to kick the bucket and not get anything. I don't want Uncle Sam to win. For those of you on the call here today, there are some have your cake and eat it too strategies. If the husband or the wife wants to turn theirs on early and then have one delay, there can be a lot of efficiencies in one early, one late, or some combination thereof. It doesn't have to be an all or nothing thing. So we can kind of scratch that emotional itch, but then still make the math more efficient than you might think in those models that Jim is talking about. It doesn't have to be all or nothing. And I just wanted to bring that up because this is a very emotional topic after one has worked really hard and Uncle Sam has taken so much for 40 years.
And so if I continue to work and let's say my husband does or does not, that my income doesn't impact his Social Security getting taken away, right?
Correct. Yep.
It would be just my income, my Social Security, his income, his Social Security.
Absolutely.
Right? Okay.
Yes.
Yeah, and there's depending on all those variables, is somewhere in the middle lies Cathy and her husband's perfect emotional and mathematical answer.
Oh, I have
if you
no
don't talk
emotions.
about
I'm
it-
all mathematical. Just
Well, we know you are, but you're different than most.
I'm just
Interesting, an interesting fact, and I think this is correct, Jim. You might be able to correct me if I'm wrong, but I believe, and if you go on to SSA.gov, it's probably on there somewhere. But I believe over 90% of people take Social Security at 62, and I would go out on a limb that says mathematically. It's probably an equal percentage of the wrong mathematical answer to take it at 62.
Fair enough.
Yeah, the two primary software packages used by financial planners are, eMoney and then Money Guide Pro. Both of them have optimization tools within them, and those optimization tools will take care of like all those interactions. So if you're working with financial planner, I just ask them to run the optimization tool to tell you what it is and why it's selected those.
good. Thank you.
Mhm.
Excellent. Now, let's think about, Jim, we're going to transition because one of your other risks that you talked about was about healthcare options. And
Yes.
that is so critical as we think about retirement. It's a huge cost. And I have healthcare through the university, right? But if I retire before 65, what happens and what should I be thinking about? Fortunately, I have the opportunity to buy into something at full cost, but at least I have that option. What are other options, or how should we be thinking about healthcare as we plan for retirement?
Well, it is, one of the largest expenses that you take on in retirement. And, as the slide references here, a study by Fidelity talks about, spending over $300,000 in retirement on healthcare. So for many people, it's one of those few non-discretionary costs that actually goes up in retirement. So for most of our clients, like we look at, just insurance and risk management in general as like, what are risks that are acceptable and what are unacceptable risks, and what risks do you insure and what risks do you not insure. Healthcare is like one of those unacceptable risks. Everyone's going to end up having healthcare insurance. It helps mitigate the risk of catastrophic costs and such. But like as you go through it, you now shift gears and kind of the lingo that you have in retirement. Because if it's pre-65, then you're looking at COBRA and the marketplace and how you get insurance, and looking at like the pre-retirees, pre-age 65. That's tough because COBRA looks into similar to what you've had in the past. It looks familiar, but it comes in and it's unsubsidized as it comes to you, so the employer is no longer picking up a lot of those costs. Coverage is usually better, so I'm always very careful with recommendations related to COBRA, and mostly to be honest with you, like within our group we have a specialist, because the healthcare becomes such an area that's difficult to keep up on because all the rules change each year. But for 65 and under, you're looking, again, like I said, at the marketplace and COBRA and where your income is going to be. And we were talking earlier about, spouses that, were working or not working. And sometimes you'll have one of the spouses that works until 65 just to maintain healthcare.
Mm-hmm.
And that's not uncommon. But once you hit age 65, the dynamics change quite a bit. And that's at age 65, you file for Medicare. You'll want to do so at a minimum just to avoid penalties that might apply. But once you have like one of those qualifying events that they talk about that you've retired, then you have the ability to change whatever your coverage is. But you get to Medicare and supplements. And for some people, as like your income goes down and you switch over to a supplement and such, you start to see healthcare costs actually start to go down. And you have the big choices that I think that most people kind of work their way to are, do you get to an Advantage plan or a true supplement? And the Advantage plans are hyped up quite a bit. I see them on TV commercials all the time. And
all the time.
Yes. And they look appealing at first because they have no premiums, but they tend to have higher co-pays, deductibles, incur more out-of-network type costs that go with them. So I'd be very careful. And the majority of our clients, we try to maybe head over more toward the supplements, because the supplements, while they might have premiums, a lot of their other costs go down, and that ends up the bigger play at that point and really that's where more of your risks are in those co-pays and deductibles and the your out-of-pocket maximums that take place.
Excellent.
One thing I'd love to point out here on the healthcare stuff is that I run into lots and lots of people every year that are working for healthcare, but yet they've never done their financial plan. So they may be working because they think they have to work for healthcare, but yet they've never spent the time to do their plan to realize that they don't have to work because they could just pay for it out of pocket.
Yeah.
Interesting.
So this is a very emotional topic that people are just assuming I have to work for healthcare till 65. Well, I know Jim probably feels the same way. I don't want any of my clients assuming what the math is until they know what the math is.
Yeah.
Because you might be working for 2 years or a year longer than you actually have to, all because you made the wrong assumption because you didn't want to do your financial plan.
Excellent.
Because of healthcare. So again, it points back to everybody needs a financial plan for all of these different reasons.
And so I'm going to, and there's another healthcare cost in this that goes typically beyond 65 that's super important that we need to deal with. And Jim, if you could, or Justin, if you could touch on that for a moment, and that's long-term care insurance, right? My mom just passed this year, and she spent 2 years in memory care, and she was in assisted living for a year before that. So clearly the expenses kicked up at the end. What do we do to plan for that? Or should we, or how do we even think about that question?
Yeah, out of everything we've talked about today, this is the least fun topic of conversation for Jim and I in our profession, as well as for people and clients to have. This is just a icky, gross conversation about aging and going down the opposite way that we all want to go down. But the important thing is that you have to have the conversation. You have to know what it costs. You have to know how it works. There's lots of really good options out there, but don't put blinders on. Don't put the earmuffs on and la, la, la. You got to have the conversation. Be an informed consumer and make the best decision with a qualified professional for you and your family.
And sometimes this decision is to not buy anything, right? You can self-insure. And some
Absolutely.
people, that's the appropriate answer. So it doesn't mean you need to buy anything, but you need to think about what the question is. And if you don't have a lot of assets, or if you have a parent that doesn't have a lot of assets, right? You would consume all your assets. And so then you become a Medicaid dependent on that. And that's the best answer too, as well, right?
Absolutely. Everybody's best answer is going to be their best answer. Also, remember, this landscape has changed dramatically in the last 10 to 20 years. So how your mom and dad's policy worked is almost guaranteed not to be how your policy is going to work, or how your neighbor's policy is going to work. Long-term care insurance is one of the most customizable insurance products there is. And it is truly, you get what you pay for. Mm-hmm. So if you've heard a horror story about, oh, my mom paid in all her whole life and then to get every coverage, that certainly may be true. I'm not saying that's not true, but there's a reason for that. Maybe they were informed, maybe they were not, but inform yourself, be an informed consumer, have the conversation, and be conscious of the decision that you are making for you, your spouse, your family on this particular topic. It's not fun, but it's important to have. Mark the box that says you checked it off the list. You know why you made the decision. You know what the decision, and et cetera. So
okay, excellent. I'm going to start thinking about. Were you going to add anything, Jim?
I was just thinking that, like, when earlier when you had what ages that people were here on the call, most people before age 55, they can probably table the discussion on whether they really need to crunch the numbers. But between 55 and 65, that's when you should probably be looking at it. And most of the financial planning software, has a section that kind of goes through, what does self-insurance look like versus that. And then the only thing that I really kind of think of is just this divergence that has taken place in, like, the long-term care world, that traditional long-term care insurance is really down to just a few carriers. So most of what you see is it turns into this product discussion of, like, some sort of combination type policy.
Okay, excellent. I'm gonna stop sharing, and we're gonna talk about different questions now. If we could go ahead and do that. One of the things we haven't touched on, which I think is also important, is some of us have mortgages going into retirement. Some of us don't. Some of us may be thinking about, do I need a reverse mortgage? That's also a commercial we see often on TV. How do we think about mortgages in retirement?
Well, a mortgage is a defined period where you have a cash flow need. So at a minimum, when you look at, like, what your cash flow needs are now, if you have 7 years left on your mortgage and you continue making the payments, that's your cash flow needs will go down at the end of that 7 years. But I think that that analysis used to look a little bit different, and I would say it was different even 18 months ago. At this point, for the people that have a locked-in 2.5%, 3% mortgage, when you can run out and buy, close to a 5% treasury bond, it's hard to say go pay off your mortgage before you retire.
And do higher interest rates change the attractiveness of a reverse mortgage? I mean, I'm thinking of my net present value calculations. Does that impact the attractiveness of a reverse mortgage because they're discounting a larger rate?
I think the reverse mortgage is quite an interesting product and has to be used extremely carefully, and very carefully. It's I'll go out on the record as saying I try to avoid them. In my almost 20 years of doing this, I think I've only recommended it once or twice. But some people are in a situation that the money they have is in their equity of the home and they don't have a choice. But most people are not probably utilizing that tool, which is probably advisable to not go down that slope if you don't need to.
Excellent. Thank you. Both of you mentioned financial plans and the importance of financial plans. We've had several questions about, so how do I find a financial planner? How do I pay for a financial planner? Can you speak to that a little bit?
Jim, you want me to go or you want to go or?
You're on a roll. Go for it.
Yeah, I mean, I think referral from a trusted friend, colleague is always probably the best way to go. You can certainly reach out to your local resources. But if you talk to your friends and family, some of them have very long-term relationships. If they don't, you can go on, you can simply do a Google search. The one thing I would recommend, no matter who it is, I would interview. Go meet 2, 3, or 4 of them. Find the person that you connect with. Ask questions, fees, credentials. I would be asking about their team, all of those things. But I would ask friends and colleagues is the number one way I would go about it. No different than if you needed a dentist. So,
yeah, I think you see some that are hourly based, and you see some that kind of build it into their advisory practicing fees. And that can be a preference. But like Justin had said, I think a lot of times, after meeting 2 to 3 planners, I find that like the client has to be comfortable enough to release information, so it turns into a little bit of relationship. The more that we learn about the client, the more that we can help them. So you have to have a good working relationship. And if as you interview people, if everyone's well credentialed and offering similar services and things like that, make sure that you're, personality wise, it's a match as well.
And if I could just interject, I think, we've talked about this in other webinars, the importance of a fiduciary. And I would say, could one of you just kind of describe that one more time, and that you want to make sure somebody is kind of acting in your financial best interest, not theirs.
Mm-hmm.
Yeah, that's been a big move in the space, probably more so in the last 5 to 7, but probably the last decade. It's always been around. But you hit the nail on the head, is that Jim and I are both fiduciaries. I know that because of his credentials. He knows that because of mine. And we legally have to do what is best for our clients, not as, how we get paid or anything other than that. And that's the industry is moving that direction as a whole, which I think is a really good thing. But there are, I don't know the percentages, but there's still a large percentage of the advisor population that does not operate in that capacity. It doesn't mean they don't, it just means that they don't legally have to. So I don't want to get into the semantics of it, but that would be very high on my list if I was looking for a financial advisor.
So you want to find somebody who is a quote unquote certified financial planner, would be one of the terms of the credentials, correct?
Correct. CPAs, attorneys, they all have to work in as a fiduciary day one. It doesn't matter what they say. They have to do that based on their legality of their credential to keep that. So there are some credentials that mandate that as part of the profession.
Great, thank you.
Excellent. And we've had several questions about thinking about this as we head into retirement. Cash reserves. When I speak in the wealth management class while somebody's working, we talk about having 3 to 4 months worth of cash reserves for an employee while you're currently working. How do we think about cash reserves in retirement? What should we be thinking about? Should we annuitize a portion of our money so that we have this stability of cash flow? How do we look at this in general? I know every situation is different. Jim?
So we look at having that liquidity reserve. If you were 3 to 4 months while you were working, that implies that at least you're in the working capacity, that it was fairly stable. Because we see some people where you have cyclical type industries that it might be more 6 to 12 months or so. But for retirees, we're usually recommending to at least have a year's worth of cash flow, maybe a little bit more than that, because that's about the time that most of these downturns in the markets take place. So I think Justin had mentioned earlier, trying to not sell when the market is down. And if you have that 12-month reserve, then, like I look at last September, if you had to sell last September, October, that was not an ideal time to sell in the markets as it hit a low. And usually, a 20, 25% market decline, we're going to have one of those types of declines every 3 to 4 years. So to have that type of decline and to have the reserve to not have to sell at that point, you can allow that reserve then to kind of ebb and flow a little bit.
That reserve can also change based on how your income comes in, based on pensions. Cathy, you mentioned annuitization, annuities, Social Security, et cetera. So you may not need a lump sum, $100,000 of cash if you have $5,000 a month coming in every month, right? Like clockwork. So that all changes too.
One of the things I've done as I've been approaching retirement to kind of annuitize for free, shall it be, is to buy I bonds, right? I can buy $10,000 worth of I bonds, and my husband can buy $10,000 worth of I bonds, which are inflation adjusted, right? And after 5 years, I can withdraw without penalty. And it gives me this little cash flow every year that I know is going to be inflation adjusted for sure, if the government's still around.
Yeah, that's been a popular topic that I'd say over the last 12 months with the inflation numbers that have come in.
Oh, right. And like you said, over long term, it's 2.5% to 3.5% maybe that you model in mostly, but it certainly is jarring as you approach a retirement right now and you see that number. It's different.
Sure. And
one question. Oh, go ahead. Sorry, Jim.
Oh, I was just going to say, as you reference like the pension income and the guaranteed income that was there, that decision is becoming different because most of the people that, are older retirees that are more in their 80s were part of a system that included more pension income. And now more of that is really kind of the onus is back on the investor. And you're seeing, it really that pot of money that people in their 50s and 60s now are looking forward, and they don't have that same kind of pension income because that doesn't exist in the same way that it used to. So I think you're getting more and more of those questions about annuitization and what that looks like. And, another one of those changes, we've tried to look through like even at the investment committee level of like the impact of inflation. And some of the impact of inflation and higher interest rates is that 18 months ago, I would not have wanted to annuitize as much because at the interest rates that they were using within those annuitizations, it didn't make sense. Now your market is more returning to normal, where I think those discussions will probably be more frequent, and the conclusions may be different than they would have been, 2-3 years ago.
Excellent. I think we're closing in on our time together here today. And one of the things I noticed, we had questions about financial calculators on the website for this webinar. We will have that connection to the Social Security. We will also have some calculators on retirement, also some other information I think would be incredibly important for those of you who are interested in learning more. And I will toss it back over to Barb.
Great. Well, I want to thank all of you. I want to check in. Justin, Jim, any last words of advice before we kind of wrap up?
There's a number of questions we didn't touch base on, so I feel bad on that front. I don't know if we have. I'm looking at all the questions. There are a lot of questions. I'll go into can annuity help with cash flow? Yes, but it depends. Again, I don't want to be vague, but it can. But again, talk to a professional person. But certainly, that's one thing that the annuity was designed to do years and years and years ago, is to specifically help with cash flow.
And there's a huge difference between variable annuities and fixed annuities. If you're just trying to stabilize your cash flow, that might be, and not every situation, but it might be more appropriate for a fixed annuity versus a variable annuity.
We could have a whole 5-hour seminar and webinar on annuities.
Well,
Indeed, we could.
yeah, there were several of these topics that we probably could have done like a lot more detail on. And that's, the follow-up for that. Hopefully, like a lot of times we'll get questions about like, how do you work with a financial planner? And a lot of these questions you'll see are going to be so specific to who each of you are. So, finding a local advisor, learning the questions to ask, and making sure that the interaction between the financial estate tax and investment planning all comes together with that, because the individual calculators are usually going to isolate one component of it, but it usually impacts all the other components.
Right.
Yep.
I agree. And I think what we've learned through all of these webinars, and especially this one today, where we have taken this massive amount of information and tried to boil it down into about 45 minutes, is that it is really important for people to reach out to paid professionals who know this business. And that, luckily the Tippie College of Business trains those people, and we are quite proud and feel that we train them well. But it is important to know that there are professionals out there who this is their day-to-day job, to figure out, to watch that inflation rate, to know what's going on in the markets, to know how rules change, because Lord knows there's many of them. So we really, really want to encourage you that you should have your own financial planner where you have that great relationship, like Jim mentioned, where you can be honest about what you want to do in your later years. And so with this, unfortunately, we're kind of coming to an end. It has been a slew of questions. We thank you for that. We are apologetic that we cannot provide more answers to you, but do know that when you get that email with the link, you will also have several handy handouts that our speakers have provided to you. So, and those are accessible from your reminder as well. Just go to the Life Lessons webpage, and there is a Social Security overview. There's a great document on evaluating early retirement, healthcare in retirement, what to do with the loss of a family member. And then there's a page with a variety of helpful links, including some of those Social Security calculators, etc. So please take advantage of those resources. So I want to thank Cathy and Jim and Justin for kind of spending this time with us and providing us with this overview. I want to encourage all of our alumni to please join us for other Life Lessons webinar. You'll receive that email in a couple of days, but in addition, when you end this webinar today, you'll get a short survey, and we would appreciate your feedback on what else you would like to hear from us, as well as some feedback on your takeaways from today. So with that, I just want to thank everyone for your time here. Go find your own professional advisor. Do the right thing for you and your loved ones. And as always, go Hawks. Go Hawks. A busy Hawkeye weekend in sports is coming up. So we hope they all do well. Thanks, everyone.
Thank you.
Thanks.